Welcome to this training session based upon my book, Invest Safely and Generate an Income for Life. It does have a proven track record. It earned over 8% per year compounded over the last 40 years. And it can also help you generate an income for life. I believe it's simpler, safer, less volatile, and lower cost investing. As a standard industry disclaimer, please review the slide. In summary, I'm providing education and opinion only. But what I'd like to do is work with you directly to help you implement any portions of the strategy that you're interested in.
The black portion of this graph shows the impressive performance of a permanent portfolio over the past 40 years. It's comprised of 4 different asset classes: stocks, bonds, cash, and gold. We allocate 25% to each asset class. The performance of the different asset classes are graphed as well. The S&P 500 is red, gold is yellow, treasury bonds are blue, and T-bills are purple. Notice how volatile stocks, bonds, and gold have been, but when you blend them together into a permanent portfolio, the volatility of the overall portfolio is greatly reduced and indicated in black. I want to share with you an investment strategy that has proven to be simple, safe, and very stable with extremely low costs. This is important during your accumulation phase, but even more important during retirement or spending phase. This portfolio can even help you generate an income for life. Knowledge is power. Once you have this knowledge, you will have the self-confidence to manage your own investments and not be dependent on anyone. You'll find that the strategy will greatly reduce your stress and you won't lose sleep over your investments again.
This is a great slide because it really illustrates that there's a lot of things in our lives that matter. And also a lot of things that we can control. But really what we want to focus on is what intersects between the two, which is a much, much smaller subset. It's really the things that matter and are in our control. The rest of it is really just noise. So we need to focus on that when we're actually thinking about our investing and our investing strategies and income for life.
So what is a permanent portfolio? Well, it's achieved great returns in the past 40 years with only 3 negative years in 81, 94, and 2013. It's a strategy that was developed by the late Harry Brown and his team back in the 70s. So it has a lot of history, but you probably haven't heard much about it. There's no money in this strategy for investment dealers or insurance agents, so they won't tell you about it. It's a passive strategy where we buy 4 different asset classes in equal proportions, hold them, and then rebalance when necessary. This keeps costs low and maintenance low and also enhances the tax efficiency. We don't try to time the market, forecast, or guess which asset class will do the best. We are neutral from that perspective. Being equally diversified keeps you from putting all of your eggs in one basket, which reduces your risk. This portfolio is not for speculators. It's for longer-term savings that you can't afford to lose. We include gold in the portfolio, which has improved diversification and stability. This is much different than your typical 60-40 stock bond portfolio, which in my opinion has way too much allocated to stocks. This is a permanent allocation. It never changes. It applies from cradle to grave, whether you have a small amount of money or a gazillion dollars. I'm now going to share with you, piece by piece, the matrix or cheat sheet that I have developed for this strategy. As a refresher, the allocation is equally balanced, 25% into each asset class: stocks, bonds, cash, and gold.
This asset allocation helps us mitigate risk. These assets tend to zig and zag with respect to each other and are contrasting. So as a blended mix, they improve portfolio stability. Stability also helps us mitigate the sequence of returns risk, which is especially important during the spending phase. Each asset class is exposed to different risks and also hedge against different risks. You've probably heard of asset correlations, and they don't actually exist. Stocks don't go up because bonds go down, and stocks don't go down because bonds go up. The assets actually behave differently depending on what's going on in the economy. You can do a financial stress test of a financial institution, but you can also do one on your own portfolio. Now, what would happen to your portfolio if an asset like stocks dropped by 50%? If you held a traditional 60-40 stock bond portfolio, your savings would have dropped by 30%. If you held a permanent portfolio, your impact would have been limited to 12.5%. No one likes a loss, but a permanent portfolio helps mitigate that risk. This is a very busy but important page. It shows the performance of the 4 different asset classes and the permanent portfolio since 2000. If you look at the assets in isolation, you can see how volatile stocks, bonds, and gold have been over time. Some big gains and some big losses at different unpredictable times. Now look at the total column. That is the performance of the permanent portfolio. Positive returns each year except for 2013, and with much less volatility. This is the power of the blended asset mix. Look at 2008, the Great Recession. Stocks dropped that year by 36%, but bonds rose 39%, erasing those losses. The permanent portfolio actually gained that year when a lot of people lost money. I have highlighted a block of time from 2000 to 2009. This is commonly referred to as the lost decade. Most investors didn't make any money that decade. If you were lucky, you didn't lose any money. Now look at the highlighted yellow box in the bottom right corner. This is the performance of the permanent portfolio that decade. It actually made its investors over 6% compounded annually. I would also like to focus your attention on the 35%, 15% rebalancing triggers that occurred. The first one in 2002. Following this strategy forces you to sell high and buy low as opposed to what people usually do. Rebalancing triggers occurred 4 times in this time frame. Finally, I want to draw your attention to the sequence of returns risk. What if you retired in 2000 and had a stock allocation in your portfolio that was very high? Not only did the stock market drop 3 years in a row, which greatly eroded your assets, you were also spending money from the portfolio, which was amplifying the erosion even more. This is why proper diversification and stability are so important.
Fear and greed were your worst enemies, but not anymore. If you were like most people, you were buying high and selling low. But now you have a much more disciplined approach to follow without the emotions getting in the way. You'll be buying low and selling high systematically.
If you were like most people, you were also too busy chasing returns, trying to time or beat the market. It didn't even do as well as some of your investments did. This has been described as the behavior gap, which the permanent portfolio will help you close.
I alluded to this earlier, but we rebalance the whole portfolio when any asset class reaches 35 or 15% of the whole portfolio. This is my preference, but you can pick a date once per year to rebalance, which is a 15-minute exercise. As I alluded to earlier, we are using economic condition asset allocation. There are only four possibilities. The economy is either growing, this is prosperity, or it's shrinking, this is a recession. Prices are either rising, this is inflation, or prices are falling, this is deflation. There are an infinite amount of unpredictable variables that get to us to an economic condition, but they also result in us being predominantly in one and only one of the four. Stocks do well during prosperous times. People are spending, business is booming, profits are being made. Stocks don't do well during inflation. Interest rates are high or rising, and the stock market doesn't like that. Stocks don't do well during a deflation or recession, as prices are falling and the economy is contracting. Bonds do best during a deflation because interest rates are dropping rapidly and bond prices rise under that scenario. Bonds also produce interest income during prosperous times. Bonds don't do well during inflation, as bonds are losing their purchasing power and interest rates are rising, which cause bond prices to fall. Bonds don't do well during a tight money recession either, because the Fed is raising interest rates to slow down inflation, which causes the economy to slow down. Cash does well during a deflation because its purchasing power is increasing as prices are falling. People don't want to spend and want to hold on to their cash. You can't get capital gains from cash, but it may end up being the best performing asset during a recession. Gold does best during inflation. Prices are rising and capital flows from stocks, bonds, and cash to gold as it's considered to be an inflation hedge. Gold can also rise when there is political upheaval or when there is a rush out of paper-backed currencies. Gold is considered to be a safe haven. Gold performs poorly during prosperity, deflation, or recession as money flows to other assets that investors are expecting to outperform gold. Let's talk about investment costs for a few moments. Keep costs low as they can greatly impact your returns, and these costs compound over time. Ongoing costs are measured as management expense ratios and are a percentage of your assets. The lower your costs, the more money in your pocket and the less in someone else's. You can construct a permanent portfolio with an MER of 15 basis points or 0.15%. The industry average MER is 1.08%. That is 7.2 times larger. And that comes out of your return. So if your asset had an 8% return, you would get 7%. And you pay this each and every year, even if your asset is losing money. Also, don't pay any of these fees either. They also eat into your returns. Now we'll dig deeper into each of the asset classes, starting with stocks. We avoid individual stocks due to the risks involved. We avoid actively managed funds because a majority of them can't even beat the S&P 500. Company stock is also an individual stock, so we want to limit our exposure there. What we want to use is a total stock market index fund if we can, an S&P 500 fund if we can't. Since there are so many companies represented in these funds, we get great diversification and lower risk than single company stocks. Since there is not much trading going on in the fund, we get better tax efficiency. Here are some low-cost exchange-traded funds that you may want to explore for the portfolio. Here's an example of a total stock market index fund. These are the top 10 holdings as of the date indicated. It is market cap weighted, and there were actually 3,780 stocks in the fund on this particular date. Now let's talk bonds. We only use long-term treasury bonds with maturities of 25 or more years. Using treasuries mitigates all of these risks. And of course, we are focused on safety. You hold these bonds until they reach 20 years left to maturity. You then sell them and then you buy new long-term bonds. The bonds are always paying you interest. There is an inverse relationship between bond prices and interest rates. When interest rates go up, bond prices go down, and vice versa. Again, we hold bonds for deflation protection. Interest rates fall rapidly during a deflation, which cause bond prices to rise. If this bond buying and selling is too complicated for you, explore using the TLT ETF, which is a low-cost, long-term Treasury bond fund. Cash can be king at times, even though investment dealers say cash is trash. Cash has very low volatility, which helps dampen the overall volatility of the portfolio. We keep our emergency funds in cash and when we need spending money. For instance, during retirement, we spend from cash. We direct our dividends earned from stocks and interest from bonds into our cash. If we are in the saving phase, we add to the cash component and rebalance only when we reach a rebalancing trigger point. For safety reasons, we use T-bills or a T-bill fund to hold our cash. For convenience, here are some low-cost ETFs to explore for the cash component. Gold is our hedge for inflation in an uncertain world. We only use gold bullion, not other derivatives or commodities. Gold doesn't earn any income, but it can produce capital gains when your other assets don't. Here are some low-cost gold ETFs you may want to explore. I have listed some of these security options in the matrix, but there may be others you want to explore. You can implement this strategy using only 4 different funds: simplicity, diversification, and low cost at its best. I mentioned earlier that we direct all of the dividends from our stocks and interest from our bonds to the cash component. We turn off all dividend reinvestments so that we are not buying more of an asset when its price is high. We want stocks and bonds to float in price naturally and then rebalance when necessary. As already mentioned, any new cash is invested in the cash component. When we start withdrawing money from the portfolio, we do so from cash only and then rebalance when necessary. Some other diversification options for you. I personally invest with 2 different discount brokers to help mitigate institutional risk. I also hold some of my gold in a bank safety deposit box and have it insured. Other folks go much farther and store all of their gold allocation in physical form offshore for safety reasons. This is the only asset class that you can do that with, since it's a hard, not paper asset. I'm not a CPA, so consult your tax advisor, but generally for tax-deferred accounts, the following hierarchy is the most tax efficient. Bonds first, then cash, then stocks, then gold. Interest is taxed the most, dividends and capital gains less. If all of your assets are in tax-deferred accounts, you have no other options. But if you have a mix of taxable and non-taxable accounts, keep this hierarchy in mind when deciding which asset to buy where.
This completes the permanent portfolio investment strategy matrix. Current owners of my book or video can order a downloadable copy of this that you can print out on an 8.5 by 11-inch paper at no charge. Just go visit my website and go to the store page and you can purchase it there at no cost. Now we will switch gears and talk about generating an income for life. During retirement, as an example. By following the income for life formula, we will never run out of money. On a future page, I'll make this simpler to understand, but if you follow some rules, you can make your savings last a lifetime. You may have heard about the 4% rule, and this is a modification to that rule. The big difference is my formula mathematically guarantees you an income for life. To get more income from your portfolio, I suggest you explore adding the right kind of annuity. An annuity is the only product available that can guarantee you an income for life. If you are interested in annuities, please contact me first so that I can educate you further and refer you to a broker I trust. I suggest you avoid fixed index annuities, variable annuities, index universal life, variable universal life, and whole life insurance products for trying to generate retirement income. The payback periods are too long. These are high commission products, which is why they're typically sold. And some can have high surrender charges. And illustrations that I've seen are just way, way too optimistic. You should separate your investment and insurance needs. Insurance should be used to mitigate risk and not bought as an investment. You should focus your annuity needs on the contractual guarantees they provide, not on hypotheticals or what they might do. Avoid any free meal seminars you might get invited to. It could end up being a very expensive meal indeed. High commission products, high cost products are typically sold at these seminars. You may also want to explore delaying Social Security for the highest breadwinner in the family. There's an excellent tool available from financialengines.com. You enter specific data and they will run many simulations to arrive at the most optimum time to start taking income to maximize your payouts.
So here's an example of the income for life formula. I'm assuming the percentage of portfolio we are spending is 4%, which is considered to be a conservative withdrawal rate. You can adjust this higher if you're retiring later in life or delaying Social Security. Whatever you're comfortable with and whatever suits your specific needs. This is just an example of how to use this formula. In this example, I will impose a 5% cap on year-over-year spending. This can also be adjusted to your comfort level. The goal of the cap is to save some of the excess gains from our portfolio, if any, for the future. Now assume I start with a portfolio of $1 million in year one. 4% of that portfolio gives me $40,000 to spend in that year, highlighted in yellow. The cap doesn't apply in the first year because we don't have any previous year income. Let's go to year two. In year two, assume the portfolio actually gained and went up to $1,060,000, a good year. I have to do two calculations. One is 4% of the portfolio, 4% of the $1,060,000, which equals $42,400. Then the other calculation is for the cap, which is the $40,000 year one income plus 5%, which gives me $42,000. I can spend the lower of these two numbers in that year, in year two, which is the $42,000 cap, highlighted in yellow. The other $400 stays invested for the future. In year three, assume my portfolio has gone down this time to $1,038,582. A not so good year. Again, I do two calculations. 4% of year three portfolio is $41,543. So that's 4% of $1,038,582 gives me $41,543. My cap is calculated by taking the year two income of $42,000 and adding 5% to that, which gives me $44,100. Now I spend the lower of these two calculations, which is the $41,543 highlighted in yellow. Now you follow the same process at the beginning of each year. You calculate the percentage of your remaining portfolio. In this case, it would be 4%. Then calculate the cap, and then spend the smaller of the two. Well, here's a very interesting graph for a hypothetical single premium immediate annuity, SPIA for short. You make a lump sum premium payment to an insurance company, and in exchange for that, they pay you an income for life. The income you get is a function of the premium you paid, current 10-year treasury yields, which is typically what these products are based upon, and your life expectancy. Those are kind of the three key variables. The bottom scale is the age of purchase when you actually would buy the SPIA. The left-hand scale is the payout percentage. And a payout percentage, the way that's calculated, it's a combination of earned interest, return of premium, or mortality credits. The higher the payout percentage, the better for you, subject to guarantees of the insurance company. An example of the payout percentage. So if your premium was $100 as an example, and the payout percentage was 10%, you would get $10 per year for life. You can see several colored lines on the graph, one line each for 10-year treasury yields, ranging from 0 to 8%, 0% being the worst case scenario. I've shown several rates so that you get a feel for the interest rate sensitivity on these products. The bottom curved line is the SPIA based upon a 0% treasury yield. The colored curved line on top is for a SPIA based upon an 8% treasury yield. So the 1 to 7% lines are in between. So every 0 to 8%. Some facts on SPIAs that you can see from the graph. The older you are when you purchase, the higher the payout percentage. That's because of a shorter life expectancy. The higher current treasury yields are, the higher the payout percentage, just like a bond. So if interest rates on bonds were higher, you get a higher payout, a higher yield from the bond. The payout percentage can also help you determine the payback period on your SPIA. For instance, asking the question, how long would it take to recapture your premium payment? Well, a 10% payout would pay back in 10 years. It's simply 100 divided by 10 equals 10. A 5% payout would pay back in 20 years. That's 100 divided by 5 equals 20. A key advantage with SPIAs is that even if treasury yields are 0%, kind of like the worst case scenario, notice that this SPIA would still pay out over 5% for a 65-year-old. Now that's the power of a SPIA when you are pooling risk with other annuitants. You are getting mortality credits and income for life, which you can't get from any other investment. Here's an example output from the financial engine's Social Security simulator I discussed earlier. I entered some specific information for Jack and Jill, including the assumption that both of them will take Social Security at age 70. That's the initial strategy that you see on the left. The proposed strategy on the right actually came from the simulator. It actually suggests that Jill start taking Social Security earlier, at age 66 instead of age 70. In doing so, this would net an extra $49,200 in lifetime payouts. This assumes, of course, achieving average life expectancies.
You can purchase a copy of my book on my website. It's available in paperback, Kindle, or in the video you're watching. The ebook is also available on Google Play, and you can get the paperback and Kindle version on Amazon.com. You can contact me now if you want help implementing any of the strategies that you've seen. If you want a referral to an annuity broker, please contact me for that as well. You can follow me in various different ways. I do publish a blog on a regular basis on my website. And here's some other contact information for you: my telephone number, email address, website, and you can follow me on Twitter and Facebook. Thank you for your time. I do hope that you found this training useful and you actually will implement it. I do wish the best for you. If this video has helped you, please do pay it forward and please do stay in touch. Thank you and have a great day. Pura vida.